Thank you so much, everyone, for joining. I want to welcome everyone here for this webinar. This is the episode 7 of the Stablecoin Builder series. And this is a webinar that we host monthly. And it's always live sessions for founders, entrepreneurs, and operators building products into the stablecoin space. We cover topics for every project at every stage of growth, from idea to funding and to shipping. And we run these sessions to help the stablecoin ecosystem grow by tackling into real infrastructure challenges together. So before we start, I just want to give a quick intro for everyone who's new here. Utila provides fintechs, banks, and enterprises with infrastructure to build and manage stablecoins and digital asset operations. We currently serve over 200 institutions across payments, treasury, trading, and more. And we help secure over 20 billion in monthly in volume every month. So today's topic is going to be about stablecoins in LatAm. As we all know, the ecosystem is evolving. There's demand driven by FX, volatility, cross-border payments, payment friction, and the need for always to have more efficient financial rails. Before I dive into the actual context, I'd like to give everyone about 30 seconds so you can all introduce yourselves. You can say your name, your role, anything you want to say, but just let's make sure because we do have a lot of in the agenda today. So let's maybe get started with Caio.
Hey guys, how's it going? Can you guys hear me?
Yes.
Oh, good. First of all, thank you for the invite. It's a pleasure to be here with you all. For those who don't know me, I'm Caio, founder at Lumx, based in Rio, Brazil. One line about Lumx, so we have been in space since 2022. So we are a cross-border payments company based in Rio. All of our people are in Brazil today, but we serve customers globally. And one of the main things on my side that I'm most excited about is that we finally got a regulated market in Brazil. So I think it's the best time to discuss the space. And since we've been serving mostly offshore companies, I think there's too many questions and things to discuss about the local market. So I'm very excited to be here and share the stage with you.
Thank you. Andres, do you want to go next?
Hey everyone, sorry for problems with the connection, but as you know, in Latin America, sometimes we have this type of situation. So very nice to meet you. My name is Andres Kim, expansion lead at Tether for Latin America. Very nice to meet you all.
Thank you. Chava?
Hey guys. First of all, excited to be here. Thank you for the invite. I'm Chava. I'm the Chief Product Officer at Movantis. I lead product, sales, marketing, and innovation at the company. Movantis, we actually just recently rebranded. So if you're familiar with either Trans Network, InSwitch, Spectrum, or Aprisa, we're the combination of those 4 companies. And we now rebranded as Movantis. We enable mostly cross-border money flows, enabling around 60% of the remittances that flow from the US into LatAm every year. We also have pay-ins, payouts, wallets, issuing, and core banking capabilities. Excited to be here with you all.
Thank you. Cristobal?
Hey, Israel and everyone. Thanks for inviting me and having Global 66 in the panel as well. I'm the partnerships manager at Global 66. Just as a quick intro, we are a global account. We allow our users to send, hold, and receive money in different currencies. We were founded in Chile, but we think of ourselves as a global account. But of course, most of our focus has always been in Latin America. So hopefully we'll bring some of those learnings, the good and the bad ones, to this conversation today.
Perfect. And last but not least, Leandro?
Hey everyone. First of all, thank you so much for the invite. It's a pleasure being here with everyone. My name is Leandro Meneses, founder and CEO of Mandioca. We specialize on cross-border payments. What we do is connecting Latin America with the world. We work very, very closely with exporters that need to collect payments in local currencies in Latin America. We convert that into stable coins. and then we're able to make T+0 payments, whatever our clients are.
Perfect. Thank you, everyone. So I think we can get started. I just want to give a 1 minute overview for anyone who joined that is not really familiar with the market context. So, according to the latest Chainalysis report, Latin America crossed $730 billion in crypto transaction volume in 2025, a 60% growth year over year, mostly driven by stablecoins. Brazil obviously dominates it. We're the largest country, but the other countries are following right after it. So we have Argentina, Mexico, Colombia, and Venezuela growing really fast, driven by lots of reasons that we discuss here today. As we all know, USDT is the default stablecoin mostly used, but we are seeing a lot of growth in local stablecoins. Brazil, for example, has over 10 BRL pegged tokens. So my first question is going to be towards you, Chava, and then Caio, maybe you can follow up afterwards. So after all this context that we just mentioned, what makes Latin America such an important market for stablecoin payments right now? Is there any country corridors or adoption signals that builders should be paying attention to?
Yeah, of course. So Adri, one of the key things that we do is we enable remittances from the US into LatAm, right? And I think when you think about, hey, what is the customer pain point when it comes to remittances? They want their money to be secure, they want it fast, right? And they want it in the cheapest and most efficient way possible. So stablecoins actually give you that right off the bat. But this is programmable money who can move instantaneously and at a very low cost. It also helps multiple companies like ours unlock idle money that we have in each of the countries. So a lot of what we used to do before was when somebody wanted to send a transaction from the US into Latam, we would have balance sheet money in each of the countries that was just sitting idling, right? And trying to get into the local payout network. So here, what we're solving with stablecoins is just how fast and how efficiently we can move money around. Once we have that, and for example, when we put it together with our wallet infrastructure, one of the key things that we can do, for example, with let's say Utila, is we can white label these to multiple of our financial institutions and retailer partners that we work with throughout Latin America. In the 19 countries where we operate, we can white label this product. And we can offer, for example, a stablecoin wallet, which it can be like a USD based account, which, as we all know, in Latin America was typically reserved only for highly affluent customers. Now we can democratize that part.
Yeah, I totally agree with Java. And just to add on that, I think the case of local stablecoins, and I think that especially since last year, we have been seeing a growth in Brazil on the usage of BRL denominated stablecoins. And the funniest part is, of course, it all started out with payments, right? At least the idea of trying to make on-chain FX, so not to actually depend on traditional rails to actually move money offshore. But actually, one of the main use cases that have been driving the growth of the volume for example, BRL stablecoins, is the possibility to offer BRL denominated accounts to non-residents, right? Because in Brazil, we have what is called a non-resident account, which is not that easy to get, especially if you're not like a financial institution offshore or if you're not regulated elsewhere. There's too much bureaucracy and guardrails with these accounts, so it's not that easy or smooth to use. And by using a BRL stablecoin, you can just, similar to what Chava just mentioned, you can just spin up a wallet and give them a BRL stablecoin. And now they have a BRL account, right? And especially in Brazil, where we have a very high yield. So today, the annual yield on treasury bonds in Brazil is like 15%. You can also make the access to these investments easier to offshore investors, right? So I think these two use cases are one of the main ones that have been driving this growth locally. And I think going forward, of course, the dollar access is still the main use case that we see for stablecoins here in the region. But I think these new use cases that will be unlocked through local stablecoins is what for example, me, I'm very excited about in the upcoming months.
I'm gonna switch to Andres, slightly building on what you just said, Kai, about dollar access. Just to check, Andres, is your connection good? Can you, no?
I don't think so.
Okay. I'm gonna switch it to Leandro, this same question. So then it's about narrative of LatAm stablecoin adoption. So it's been traditionally associated to inflation and dollar access. But do you think that it's a time of a change of narrative? Like, do you see that stablecoin adoption is coming from another side right now, or do you think that it's justified and to be continued like this?
So I think that something very important to note is that LATAM is not a single market. Each country in Latin America acts on its own. It's its own world. So especially in the stablecoin world or in the world where we move cross-border payments using stablecoins, each market is completely different. The necessities that the USDT has in Bolivia or in Venezuela are not the same necessities that Mexico or Brazil are going to have, or Argentina or Chile. So it's very depending on each market. And one thing that we've seen that is very repetitive is that at the end of the day, clients needs efficiency. They need to solve problems. Definitely, one problem is volatility, is devaluation of the local currency against the US dollar. But in other markets, like such as Bolivia, is a necessity because access to US dollars is not even possible. We came to the point where in Bolivia, for instance, the rate for US dollars or is not the rate that the central bank gives, is the Binance P2P rate. In Venezuela, if you want to make an import, making the payment using US dollars is almost impossible. You need USDT. In Colombia, we get a little bit more into banking infrastructure. So banking infrastructure is outdated. Payments are going to take very long. So now with stable coins, being able to, instead of sending an international wire, you can send a domestic wire where the market is going to be the solution. So the narrative, I think that's still the same. Like definitely a lot of people are looking at stable coins to protect themselves against volatility or inflation. But then there's also other markets where the necessity is different and the narrative is going to be more like we need to solve the problem or how we can be more efficient about sending international wires or how we can receive money. And that's where USDT and stable coins they play a very, very important role.
And to get your perspective, Cristobal, on specifically like the remittance side and retail, do you think that users are using Global 66 for the same reason a year ago, or is there a shift?
I do share pretty much the same view with Leandro. I think that Latin America is absolutely not a country at all. This might sound obvious, but when you land in Latin America, you realize each country has their own needs. But even if you want to force the comparison or the similarities among these markets, I think apart from the obvious inflation and USD access, I think we're seeing a new trend in adoption, which is payments efficiency driven. I think that many countries, so for example, Brazil, Mexico, and Chile, might have local rails that are more developed than some other countries in Latin America, but the cross-border payments remains to be pretty frictionful. So that said, I think that stablecoins are pretty much matching the field between the local rails and the cross-border payments. So I think that's a second trend that's driving a lot of the adoption there, and we are seeing that for the remittance size. One thing that I'd like to highlight on this is that the user and the level of adoption, it's going to be linked also to the financial education that one market has. Because, for example, the amount of understanding that a user in Brazil has is not the same that we can see in Peru or Bolivia. We understand them differently. So I think the flows must be designed having that in consideration as well.
Perfect. And just before we move on, Andres, because I think that your perspective from Tether side is very important here. Do you have connection now? No? Okay, no worries. We can move.
Okay. Yeah, we can go back to him once he's back. I think I want to go back to Caio, what you mentioned specifically, and we all know that Latin America is a region and everything is really specific. And when it comes to stable coins payments, we just talked about traditional payments, rail, cost, and speed. But do you think that there's any other specific problems? And I think you were kind of starting on that when you mentioned the Brazil tokens, but specific problems that stable coins clearly outperform what's being offered in the traditional rails today in Latin America?
Yeah, I think like talking about Brazil specifically, like recently, especially last year, we had um, a thing regarding FX taxes, right? And stablecoins in Brazil specifically, at least up to this point, have been leveraging this regulatory arbitrage. So in a sense where companies have been able to save tons of millions of dollars in fees that they would otherwise pay if they use the traditional rails. But of course, I think this specific situation is more time sensitive. I don't know, how long this will last. But besides that, like talking about infrastructure, I think and Brazil is a very, very interesting sandbox, right, to experiment with these use cases. We have been seeing right now because years ago we had Drax, which was the Brazil uh, experiment with CBDCs. The project failed, but the idea stayed, right? In order for us, okay, we need to rethink how the financial market works in Brazil. The capital market specifically need to be modernized. And this sparkled a wave of now the incumbents and the banks and everyone that was they were in the Drax pilot. They are now doing the same things that they did before, but using stablecoins. And I think this is a very cool thing that happened in Brazil because again, Brazil is a very evolved financial market, but I think the traditional rails, specifically on the capital markets, needs to be reshaped, and now I think is the best time to do that. So we have been seeing a lot of platforms and products using stablecoins to give to offer traditional financial instruments in a way that is cheaper, more efficient, more transparent, easier to reconcile. So for the back office, definitely happens. Definitely helps. Sorry, and I think that one of the new things that appeared not only in Brazil but worldwide, and stablecoins are also an easier way to access, is for example new financial instruments such as prediction markets, right? So I think that in Brazil we will see this wave and this huge growth of new financial instruments being unlocked by stablecoins. So I think right now in Brazil, of course, we always talk about payments, but I think capital markets right now we leverage the whole evolution that we have recently in this space.
Perfect. And James, sorry, just before you move to your question, because Caio was mostly focused on Brazil for obviously good reasons, is there anything else that the non-Brazilians panelists want to add specific to the regions that they're seeing? If no, it's fine.
I can add something really quick, for instance, of what we're seeing in Colombia, Venezuela, or Bolivia, where it's very important to note also like how the stablecoin rails, they're changing the way money flows and how is compressing settlement time and improving the capital efficiency of these countries, especially with the issues that they have with very, very outdated banking infrastructure.
And just to build on what Leandro said, I think that's one of the key challenges that we encounter, right? Like, how do we connect the stablecoin world with the local fiat payout rails, right? Even the real-time payment networks, they have cut-off times. They don't operate 24/7. They still have issues. There's still that gap that needs to be bridged, and I think that's a huge opportunity for operators in the market, right? Like, our view is that fundamentally money flows are going to move entirely like from stable into stable, but during the transition phase it's very important to bridge in the on and the off ramp. Hey, what happens with that lag?
I'll build on a question similar to this, specifically for Cristobal and Chava. because both your companies are traditionally fintechs, like traditional fintechs, and are moving into stablecoins, how do you describe that journey, like from inside, from outside? Like, what has been the process internally?
Do we want to go first?
Take it away, Crystal. You
Okay.
just talk.
It's interesting or funny, depends on how you look at. As you said before, we were not born as a stablecoins company. What made us look into these flows and this new paradigm? Sorry, I think it's our users. We had a lot of demand from the market. Our users were already transacting in the stablecoins ecosystem, and they started demanding precisely what was mentioned before: a connection and a bridge between the stablecoins and the fiat world. The on-chain rails are not going to be valuable enough if we are not able to provide this fiat connectivity. And I think it was good that we focused initially on our fiat infrastructure. We have been in the market for something around 8 years, and we have been targeting every market, every corridor, one by one, connecting to the infrastructure, building the partnerships, getting the licenses for all of our operations. And precisely, we started asking our users, they started requesting the flows. And that was what we built first. We initially allowed the users to receive in stablecoins addresses directly into their wallet. So there was an automatically converted flow from the stablecoins to any fiat balances they have. And the volume came along pretty quick. Like every time we launch a market, we see a growth that, of course, it's pretty interesting and high. But with stablecoins, the flow was like there from day one. And it was the same when we launched the opposite flow. So we enabled our fiat balances to execute payouts into external blockchain addresses, and the volume came along pretty quick. So what made us look into stablecoins? The demand of the market. Our users were already there before us, and we wanted to be that bridge between the fiat and the stablecoin world.
And for us, I think it's very similar in the sense that it comes from demand in the market. The one key difference in our case, because we're mostly B2B2C company, right? So we enable remittances that a customer in the US goes to a remittance company, they send money to a payer in LatAm. We enable that money flow. So if somebody wants to send even cash, right? We even enable cash flows, like physical cash in a Western Union or MoneyGram in the US, and they want to go to Walmart in Guatemala or the local bank in El Salvador, we enable 60% of those flows. In our case, it's mostly about if we fundamentally believe this is where the money is going to be moved in the future, then we definitely want to be enabling those flows for our partners. So in many cases, actually, the very traditional financial institutions throughout Latin America that we operate with, they're actually still like not fully convinced, right? This is a lot about like abstracting the complexity, abstracting the compliance aspect. So we take on that, and then we can offer them. Basically, they don't even need to know that we're utilizing stablecoins. They just care about the money getting there on time, at the fastest speed, at the lowest cost. And if we can provide that while utilizing our infrastructure on stablecoin, then that's a win for them. Once they realize that's what we're doing, then there's a more openness to be utilizing stablecoins in a more active way. So then we can white label that product for them as well.
Perfect. Well, you wanna go, Adri?
Yeah, I actually want to. I saw that this question was maybe focused and we touch more on some specific use cases. I want to maybe ask if Leandro or Caio, do you think it's like the same for B2B traditional payments? Do you think that there is just like specific pain points that make stablecoins uses like thinking on a B2B use case, or is just like interesting and people are doing it?
I can start. So I think definitely these affect the B2B market as well a lot. We see this, like from I don't know exactly the banking infrastructure in Brazil, like how international wire works, but at least what we've seen in other countries, that any international wire can take several days. So for a lot of importers and exporters, there's always been a pain point how traditional wires using Swift, there's multiple intermediary banks in the middle. And the issue is that having so many players in one of those intermediary banks could be a request. So a wire that should take, I don't know, 2, 3 business days ended up taking 10 business days. But then if you put stable coins in the middle, and instead of sending an international wire to China from Colombia, Bolivia, Brazil, you just send a wire either directly via China or directly from Hong Kong, like you're compressing the settlement time. So this is going to allow companies in the B2B market to have more working capital. That this is going to create working capital efficiency. There's going to be a very, very strong advantage in fragmenting banking corridors, especially from Latin America to Asia. The corridor LatAm to US is a bit better, not saying that it's more efficient, but this is where stablecoins completely change the rules of the game. Pretty much with stable coins, you're able to send domestic wires whenever you need to do a transaction, and you're going from days to minutes. And this wouldn't be possible without having stable coins in the middle.
Just to build on that, Leandro, and I think Caio, you can follow up as well on your views. I think you were mentioning about where stablecoins go in, the fragmented rails. Like there's this big assumption that stablecoin sandwich, where fiat to stablecoins, back to fiat, no intermediaries. That's not quite the case, right? Could you just give a bit of a walkthrough on what these steps are? Like, what is this flow looking like today?
Do you mean for the stablecoin sandwich?
Yeah, but in a more detailed sense. Like, what are
Got
these
it.
players in the middle? What do companies need to think about in terms of these intermediaries?
Got it. Yeah. So when you think about the the quote unquote stablecoin standards, you usually have like the figure of an OFI and a BFI, so origination financial institution and beneficiary financial institution, who usually are the players who hold the local licenses to process fiat, right, to collect or do payouts in fiat in each of these jurisdictions. Of course, you have the liquidity providers, which can or cannot be the same player, right? Because some players do both roles here in the process. But usually, at first, you have a fiat collection. So let's imagine it's a BRL to USD transfer, right? So at first, you would have a PIX transfer, all right, from BRL to a bank account located in Brazil. Then this fiat balance will be converted to a stablecoin using a local liquidity provider, which again, especially now with the regulated market in Brazil, also needs to be a regulated entity, or at least have a partnership with a local entity in Brazil. Then usually there is a transfer from the stablecoin from the local custody to an offshore custody to another partner who actually will be the one who will do the last mile, right? Then we have another conversion to a local fiat currency, then the local payout to the beneficiary bank account, right? So it's funny because we always say that, and it's kind of true, but we always say that removes intermediaries, but you can actually have a lot of intermediaries too, right, in the process. But it happens that the process is easier and faster, and not always, but most of the time cheaper, right? But you also have a lot of risk, right, in the process because, for example, if in the middle of this process, the liquidity provider or the last mile fails, you have a problem because you need the like transaction already went through and you need to revert or do something on that. So I think in our case at Lumx, what we learned a lot in this process is how to actually make the transaction monitoring and the whole transaction engine very granular in a sense where we can know exactly when the money is and exactly what to do when something bad happens in each of these steps, right? Because the client will ask where my money is, right? So we always need to be prepared to act um, and be able to make sure that everything goes well. But yeah, the stablecoin sandwich is definitely today 80% of our volume. We still don't have that much volume locally of people settling in stablecoins, right? This is a process of ramping up. So that's why we, uh, invest a lot of time to making sure that the process is very reliable and we are able to make sure that everything goes well.
Cool. So building on this flow that you just described, Caio, switching to Leandro and Cristobal, you can give your thoughts as well after. You can when you're running your business, you can think about how much of this you want control over and how much you want to delegate. So Mandioca has grown a lot in the last 2 years. What's your perspective on what's the most important thing that you have had to take control in this stack? Like, is it the liquidity partners? Is it the wallet infrastructure, the support, client support? Like, what are your thoughts on that?
Yeah, so one thing that is very important is that operators, they must control orchestration and visibility. You definitely need to start controlling the treasury. So owning the wallets, it's very, very important. After that, you need to have control of your compliance, of your KYB process, on your KYC processes, making sure that even if you're using a third-party provider, that you always have all of the documentations on your own, that you can custody those documents as well. And then, of course, is the liquidity. The liquidity part is more on the revenue aspect, because the closest you are to the liquidity, the most effective or the smaller your spread is going to be. So your margin is going to be bigger. But I feel that without having control of the treasury with wallet infrastructures, like with Utila, for instance, you're never going to have the control. So I will say that it's very important that you control the compliance, very important that you control the treasury, very, very important that you also have control of your technology. And then after that, but this is more from the revenue side, the more you control the liquidity, or the closest you are to the source of the liquidity, or if you can source your own liquidity, that's where your margins are going to be bigger. But that's more from a revenue perspective.
Any thoughts on the remittances, Chava, Cristobal?
It's okay if I start, Cristobal?
Okay, I'll go.
He- he-
I think. Sorry. Go ahead.
I said, if is it okay if I start this time?
My bad.
We'll take
Go
one
ahead.
on
Go
one.
ahead.
So yeah, I think from our perspective, like if you think about the how do we move money today in the TradFi world, right? As I mentioned, we take a USD in the US from somebody, and then we use balance sheet money in the target country to distribute, let's say, Guatemalan quetzales. But at some point, that fiat money needs to move. That fiat money moves via wire transfers, and it uses a set of corresponding banks that combine, they offer you like a certain FX rate and like multi-day settlement time, right? And very low visibility about where the money is at any given time. As we move into the stablecoin sandwich, one of the key things that happen is we mint either use a partner to mint, or we mint stablecoins ourselves, right? And then we move it to a wallet, and then we use an off-ramp / liquidity provider. As part of that, a lot of what we're connecting wallet infrastructure provider, like Utila. We have liquidity providers, and then we also have know your transaction providers, because we work with highly regulated financial institutions. So in terms of like, hey, which part of the stack should you own? We definitely own all of the orchestration. We own the end clients on both ends. But when it comes to expertise, we always look for experts in each of these realms to connect them and integrate them into our product offering. So we believe those jobs are much better done by experts than developing them in-house, which could take a very long time to market.
Cristobal, do you want to add something?
Yeah, for sure. I mean, both Leandro and Chava already provided a pretty good and comprehensive view. I just need to add that Caio said something that's really valuable and hard true. The stable sandwich is anything but simple, even if we want to think about it as an improvement. So that being said, I think in terms of the control, you need to, if you believe in it, you need to invest and build on it. So whatever you and your company are good at, you need to control it yourself. If you're not good enough or it's going to affect your flows, your users, your UX, you need to rely on a partner. Just bear in mind that if you bundle or use just one partner for everything, you're going to lose control and visibility. If you have too many parties and too many partners in the middle, you're going to make the service fragmented and therefore lose the value of what you want to achieve, which is actually speed, control, visibility. And I think that's a decision every company has to make. On our side, we have decided to rely on a couple of strategic partners, but of course we always have this land and then expand approach to the market. So if we see in the future that we need to expand what we do by ourselves, we are of course going to do those steps as well.
That's great, guys. I just want to add one thing to it, to everything we're talking about like this black box thing, and it touches on everything we've discussed so far, right? So when we're talking about traditional payment rails, and I think Caio, you mentioned it, everybody wants to know where the money is. But if we look at like traditional Swift, you have so many players in the middle, you have so many people to ask information from. And then we go to stable coins. If you just put more people in the middle, the information also gets lost. So we've, from our side at Utila, what we see is that when companies start to grow, it's exactly what you guys said. You want to control everything that you feel it's in your control. You don't want to lose margin. You don't want to lose revenue, especially when we were just talking about like remittance, which has already a tough relationship on the revenue part. So it is something to keep in mind for the builders who are watching this, is as you grow, how much do you want to consider and keep controlling your own stack. And before we move, I just want to confirm if Andres, are you here? We saw that you're back. Can you, do you think you can uh, maybe try to answer one question for us? Okay, so this was a question that James had for you, but since I'm here, I'm going to ask. We wanted to know that from your perspective, what is driving USDT usage across LatAm, specifically in passing other currencies?
See, well, very interesting question. I would say that the common mistake that companies, especially international companies that see LatAm as opportunity, is like when they put everything in one basket. And for me, or for us, every country is very particular. Of course, have some similarities, but it's not the same market, right? So, for example, we can see drivers like use cases like hedge against inflation in Venezuela and Argentina. But then you can see in Colombia that one of the most common use cases is arbitrage. And then if you compare with Brazil, I would say that the number one driver is on cross-border payments. So every region is very particular, and actually that's our how we differentiate of the competition. We do have local presence, and we try to really understand what is happening inside the country and have a tailored solution for each one of them.
Perfect. We're really happy you're back. James, you can continue.
I'm just gonna ask for anyone who is like, because this is so fragmented and every country is so interesting. In this last year, starting from January, let's say, what's the country that has you most interested over what's happening, like nuances and trends in the region, of course.
Yes, don't say all US at once, guys. Come on.
I can start, James. Okay, perfect. Thank you. I will say Bolivia. I think what Bolivia has been adopting, I think that how banks, they're starting to take USDT and they're trying to get into the market. How in this moment I cannot remember how they call the Pix in Bolivia, which you can pay with QR. How other wallets provider, they're connecting that with stable coins. How now importers are not asking what the local currency to USD is. Everyone is asking what's the spread against the USDT. I feel that now the currency for cross border payments in Bolivia, it's definitely the stable coins. Bankings are getting into it. Prepaid cards. It's there's definitely a big movement in Bolivia that has been evolving, especially since January, which is very excited to see.
I totally agree with Leandro. So for us, Bolivia is very special. Of course, from the adoption perspective, because still a small market comparing with, let's say, Brazil, which is the number one in terms of um, volume. But in Bolivia, it's very interesting because people basically use it to solve a huge problem for people that are looking to have a hedge against inflation, but also have to buy um, providers from providers, international providers, raw materials to be able to produce from the internal economy. There is a very interesting number that shows the actual impact that happened in Bolivia in the last 2 years. So uh, the total amount of money that was the basically inflow of the country in terms of digital asset in 2023 before the regulation, it was $500 million during the whole year. Then the first year after the legalization, which was 2025, that amount of inflow of dollars through digital asset went from $500 million to $14.8 billion. And this is, I mean, we're talking about a country that have 1 year and a half of legalization and not too much education about the market. So I really believe that there is a lot of potential. Government seems to be um, keen to support initiatives and companies that are developing on this area. So if everything goes um, well with the new administration, I think they have a good chance to be around the top five volume the last 2 years, let's say.
Also, the fact that USDT shows as currency in the airport of Santa Cruz in the Viru Viru, which is quite impressive.
Also La Paz. I
La
was
Paz.
yesterday there. It was the first time that I saw the La Paz one. Of course, it was very nice to see that has helped to local um, uh, companies, but also stores to keep the value of their goods. So USDT as a payment infrastructure is one of my favorite ones, by the way, because strike a lot of the friction for the tourism. So I think there is a lot of potential, but not only for Bolivia. I think that that could be an excellent case for Peru, for example, also for Mexico. I do see that there is a lot of remote population moving to Medellin, for example, in Colombia. It would be very nice to build a nice payment infrastructure for tourism and also digital nomads there. So yeah, every region is different, but a lot of opportunities we see.
Perfect. Very cool. I really love the fact that we always keep reinforcing that LatAm is not a single country. There's just so many cool topics about every single country specific. But I want to maybe move towards the ending because we only have 15 minutes, and I already see that we have a few questions. So I want to talk about product now, and I'm going to ask you, Chava, but then Cristobal, would love to hear something if you want to add as well, which is, so when we're thinking about products and maybe users or companies that are not crypto native, that are not, blockchain experts, how do you design and build a product fit for it?
Of course, Heather. And I think one of the key things that we want to do here, right, is we at the beginning we want to even abstract the fact that we're working with stablecoins, right? We as we incorporate this into our rails and as we actively utilize it to send money, because in reality, what we're doing is we if you think about the payers, the companies that receive and pay out remittances, right? What they really want is they want money that was sent in the US in USD. They want to receive it in local currency. Whichever mechanism that we utilize to get the money there, they're okay with it. And then we're running with, of course, everything like compliance, regulation related, right? But if we utilize any mechanism, they're happy with it. As long as we give them speed, cost, and security of that money. Once we prove to them that we're giving them faster speed, better unit economics, and a lot of security in utilizing this rail, we can tell them like, listen, there's in this rail that we've always been using. Could you be interested in using it yourself? Like how about we can work with the MTOs on the originating in stablecoins, and we can work with the payers to also do the payout in stablecoins, right? So I think the answer to your question, Adri, is very gradually. These traditional financial institutions, they move very slowly. And I used to work at Citibank for many years. And then I was part of the team that started Nubank. So I know both sides of the spectrum, Nubank in Mexico. Uh, so the way to introduce these highly novel products to them, it's in a very gradual basis, showing them first the value and then expanding on that offering until you can get to like a white label wallet with a card that we can issue that goes and transacts against the stable coin balance, and that we can sell it to the customers in like, hey, this is a USD based account. It can give you yield. It has this card, technically debit card that is attached to it. Oh, by the way, it just so happened to be a stablecoin wallet product. So I think that's at least how our roadmap looks in terms of expanding access to these products.
I agree with Chava on that. Yeah, for sure. I think we need to frame the stablecoins correctly, because it can be treated either as a product or as a technology enabling whatever solution you are delivering to your customers. And in terms of the product design, we have one simple principle. We abstract everything that creates confusion or anxiety to our users, and we surface and highlight everything that builds confidence. So that means what we can abstract, for example, in the blockchain, whatever are complex mechanics, we just remove it away. For example, the gas fee management, we just assume it on our own. Or as Chava said, we might abstract the crypto or the blockchain leak in the flows completely, because the user wants to move money, as Chava said, from point A to point B. So whatever the user don't want to know or doesn't need to know, of course, we are going to take it away. And on the other side, what we're going to surface, real-time status updates, a clear confirmation where the money is at one exact point, clear FX rates applied at the moment of the conversion, the total amount of money that's going to be received. And that applies to pretty much all of our flows, except maybe for B2B. They need slightly more details. So maybe including configurable timestamps and some other information that they want to receive. we provide an API, for example, for them to build their own reports and transaction historic. And I think that has been working pretty well for us, and I think it's a good recommendation for other builders in LatAm as well.
So, one last question from me, and then we can go to the comments. And it's also connected to the last thing you said, Cristobal, about the advice for the builders. But my question is for the founders here. So, Leandro and Caio, what are founder lessons? Like, what have you learned building a stablecoin company? What advice would you give yourself 2 years ago, and at the same time to the builders building at it right now?
I can start. I think when you think about the classic like old sayings and kind of lessons from the Silicon Valley, that's the classic saying of move fast and break things, right? But what we learned is that you cannot move fast or break things when you are dealing with other people's money. So this is like the first lesson that we learned. Not that we broke things before, but we always had this very responsible mindset that okay, maybe we can launch an MVP, and of course we want to move fast. Of course we want to launch products at the speed of a startup, right? But especially when you are dealing with other people's money, that of course has risks. And right now, especially where we are in the regulated market, I think you can definitely, you need to definitely not underestimate compliance and the control that you need to put in your product. I think this was the main lesson that we learned on our side. And I think, like being honest, of course, these things you kind of only learn when you experience it, right? When we deal with the problems and we deal with regulators and we deal with all the whole thing that need to be done in order for you to be a global company. But I think the main lesson will be uh, going backwards is, of course, think about the product, think about the design, but also always use the regulatories and the compliance framework as kind of a model to then design the product for you not to face any problems after. So I think this was the main lesson on our side.
Leandro, I'm gonna give you 20 secs.
So there's many things that we could have done differently, but I think the most important lesson is that you need to start. Like there's so many things that you want to create. You focus a lot on the product, but then you see that you also need to focus on the compliance, that you also need to work on the legal framework. But maybe there's a lot of lessons, but one that comes to mind is that whenever you're speaking with consultants or whenever you're speaking with lawyers, you need to come up with the questions necessary. If not, that bill is going to be humongous. And then always understand the responsibility that lays on your back, because you're moving capital. Like I think that we always knew here at Mandioca like how important was our work for a lot of our clients, import and export, but then you don't see it until you feel it. Like there's a payment in Singapore that needs to be made right now because the ship is not going to depart. And then when you still having that pressure, you're like, oh, okay, like we need to have all of these things on point. But they're definitely lessons that we polish, and we're very proud of the work that we've done so far.
Thanks, guys. So I see we have 4 questions. We're going to try to answer all of them in 5 minutes, but maybe we just run past it a couple of minutes. So the first question is, which countries are considered stablecoins friendly and which aren't in LatAm? And how are you planning against regulators? So we don't really have a compliance experts in the panel, but maybe someone wants to take it specifically.
I'll go with a few comments on this one. So, first of all, you don't have to go against the regulators. That would be my first advice. And I think that was one of the lessons that a few of the panelists today shared. Secondly, the market's shifting. The regulations are still developing. I wouldn't say there's one specific market in Latin America that we can consider that settled. We all know that MiCA and the Genius and Clarity Act in the US are pretty much driving the regulation across the different markets, and they are not even there yet. So you don't need to plan against the regulator. You need to plan with the markets and with the rules in place and prepare for them, because they are going to change. You can be certain of that. Take, for example, Brazil. We have 2 massive bills in the last 6 months. I remember a few headliners in LinkedIn pretty much saying that Brazil banned the stable coins at all. And if you go a little bit deeper, you're going to realize that that's not it. So just bear in mind that whatever you design, it's going to change, because we're still trying to figure out how this technology is going to work in the world, I guess.
I'm going to jump to one by Charlie Bernos, which I think is really interesting. So right now there are sanctions in Venezuela, but not long ago, crypto was basically the main method of movement, or whatever, with its nuances. So what are your thoughts when the sanctions are lifted? What's happening in Venezuela with crypto?
Maybe we can focus that to the Venezuelan in the group.
Yeah, that would be. Yeah, let's start with Andres.
Yeah, sure. Don't look like, but I'm from Venezuela. So yeah, I think the use case probably will switch. So I do see Venezuela very similar market in terms of use case to Argentina right now. But I would say that after a scenario without sanctions, I would see that figure will evolve more into what is happening in Brazil. So of course, I mean, we are heavily dependent on imports and exports. A lot of companies have learned how to use stablecoins because of the necessity of the access and speed and all the benefits that we already know. But after there is a clear regulation framework and also ability to have more exposure to this technology, I would say that the main driver is going to the cross-border payment side.
I don't think we're going to be able to answer all the questions, and I think that's a good thing. We really like when there's a lot of questions. I just want to give anyone a 20-second space to add something that wasn't touched, or maybe go to specifics on the Venezuela topic, or everything that you want to share to the watchers.
I'll take those 20 seconds. I would like to build on what Cristobal was saying of like, hey, you don't need to go against the regulators. I think there's a very strong opportunity here to first be flexible, of course, because regulation is going to be changing, but to start trying to play as far ahead as you can, given the current regulation. And we actually believe there's an opportunity to play close to the regulators, given the sheer amount of institutions like financial institutions and big public companies that we operate with. It's in their best interest to be working very close to where the rules are, where the laws are. So the real opportunity here is to bring the compliance, KYC, AML controls that we have in the TradFi world into the DeFi world. We believe there's a very strong opportunity there. So I would actually say, yeah, a lot of the playbook, at least for us, is to play along what is the latest from the regulators.
Very well put. I do want to thank everyone for joining. We're just on the time. We will try to address the questions afterwards. On behalf of everyone in Utila, I want to thank every single one of the panelists. James as well for joining this together with me. And that's it. Thank you so much for watching and for joining us today.
Bye. Thank you very much for creating this
Thank you,
space.
everyone.
Thank
Thanks,
you for
guys.
having
Appreciate
us,
it.
guys.
Bye.
Thanks. Bye-bye.
Bye-bye.